new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, death at the door, wherever you get your podcasts.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, he's got the wisdom of a baby boomer, but none of the wealth. It's Anthony Macdonald. How are you, Anthony?
Oh, it's great to have the chooks back together on the pod, isn't it, James?
Absolutely. Well, this week we look at how the extraordinary boom in boomer wealth is changing the economy. We look at the next Australian AI heavyweight, and we answer your question about private credit cockroaches. But first, Anthony, let's start with the banking sector. And ANZ's new CEO, Nuno Matos, held his big strategy day on Monday, and we learnt two things, I reckon. First, banking in Australia ain't what it used to be. And second, Nuno hates consultants. Is that a fair summary, mate?
Yeah, good summary. Next topic. I agree. Nuno did a great job summarising Australia's banking sector. You know, a lot of competition, not a lot of product differentiation, a lot of reliance on interest income from lending out money. And yes, he said he doesn't like consultants, but I reckon this new strategy, James, had the consultants' fingerprints all over it.
Oh, totally.
I think he was just telling the crowd what he thought they wanted to hear there. But it was good to get Nuno's strategy for ANZ. You know, we've had the job cuts, we've had the leaks, the rumours, the speculation. We've been talking about it for weeks. And I think most of it proved pretty on the money. So the big thing from the strategy day was the cost cuts, $800 million for next financial year. Firm, done cost cuts, not mucking around. He's like, that's a proper target and it's a lot. The next big thing were the return targets. So he wants to increase the returns at the bank. So they made about 10.4% on its return on tangible equity last financial year. He wants to get that back up to 12%, 13% by the end of the decade. That's good. And then there was shoring up the balance sheet. So he's not going to cut the dividend, but he is going to pay a dividend and then ask for it back from shareholders and give them a little incentive to do so. And through all of that, I think the most anticipated thing was this whole ANZ Plus retail banking platform. Now, that's a project that's been underway at ANZ for probably half a decade now. It's spent over $1 billion working on it. And he's basically managed to scale it back and expand it at the same time.
Yes, so that's true.
This ANZ Plus, it's going to become like the retail banking interface that all the ANZ customers will see. Within the next 2 years, it should be all rolled out. But it sounds like he's scaling back the sort of the back office nature of it, the core banking tech. Now, I think all in all, James, reception was pretty decent. I mean, analysts are doubtful whether he can make those return targets without an uplift in the revenue environment, which, as he made clear, given the challenges in Australian banking, is really hard to bank on that revenue growth. But, you know, it was good to hear from Nuno. And guess what, James? The customer's going to be at the heart of everything ANZ does.
Do tell, Anthony. Do tell. Look, it was interesting to see how analysts sort of applauded him for having a go, basically.
Yeah.
Good on you for putting some gutsy targets, some bold targets on the line. We don't think you'll make them. And this is the important bit. It's relatively easy to cut costs. It's hard to grow revenue, which is what he needs to do to hit those return and cost to income targets. It's fine to get cost to income down, but you've also got to get the income bit up. And that's not easy when you've got, you know, a behemoth like Commonwealth Bank, a disruptor like Macquarie Bank, just waiting to eat everyone's lunch. So that's going to be the tough bit. The next 3 years of cost cutting, fixing up things like ANZ Plus, getting the house in order. That's the sort of hard work that Nuno's ready to do and raring to do, I think. But it's that other bit, the growing revenue bit, growing the business, that's going to be a lot harder. But just back on the consultants, Anthony, we should explain this a bit. He was asked by an analyst, Matthew Wilson from Jarden, you've just hired a guy from McKinsey to be the head of retail banking. Is this going to be a consultant-run bank? And Nuno uttered those now famous words, "I hate consultants." And then he sort of had to correct himself. "I like some better than others," is, I think, what he said.
Yeah.
But to your point, there was a lot of consultant talk in there. I mean, this idea of horizontal management was, I've heard of horizontal folk dancing, but horizontal management, do you have an idea of what that is?
No idea, mate. There was talk of horizons, phases. There was buzzwords all through it. But James, what do you make of the other big Australian banking news this week? The Matt Common's likely to be around at the CBA for at least another 3 years.
Yeah, look, I think this was a little bit unexpected that CBA would come out and put a stake in the ground and say Matt Common's here till at least 2028. I think we've all heard the speculation over the last 12 months particularly that he's closer to the end of his tenure than the start, and there was lots of succession talk, but this sort of puts all that to bed for a while longer. I mean, I guess there's a few ways to look at this. I think investors will be thrilled. I mean, this is the guy who's sent the CBA share price to record after record. He's the guy who's got the sort of flywheel going and helped make CBA the bulletproof bank in the Australian market. There's always the other side of the coin, though, Anthony. There's probably a few people inside CBA who thought they were in line to be the next CEO in the next couple of years, and now they'll be waiting. So I guess we'll see how that all works out.
We will. That's life, isn't it, James? Now, I had a week off. I was touring New South Wales and spreading the good oil on the chook pod and found some fans out there, James. You'll be happy to know. But I can't say I really missed out on the daily Donald Trump show. I mean, things got pretty hairy last Friday night when he suggested he would impose an extra 100% tariff on China. Markets tanked, and I could picture a bear like you loving life. But it didn't last long, did it?
No, this was a fleeting moment for the bears. Wall Street was down 2.7% on Friday night. It was quite a dramatic sell-off. Sort of volatility spiked. Everyone was saying, oh, well, markets have been primed for a correction for some time. And the timing was interesting too. Trump came out and threatened this tariff increase before the market closed. And then after the market closed, he said, yes, I'm definitely going to do it. And this is all about the controls, the tighter controls China's placed on the export of rare earths. So look, the Donald got everyone pretty scared on Friday. That continued into Saturday. And then, as only the Donald can do, he puts out a social media post on Sunday and says, don't worry about China. It's fine. Me and President Xi are good mates. We'll sort all this out. And on Monday, everyone just started buying again. So is there still a bit of fragility under the surface? I reckon there is. I think we've been reminded that trade tensions haven't gone away. We've been reminded that AI valuations are pretty toppy. The market's pretty stretched. There's some crazy leverage plays going on. The crypto market had a bath on Friday night. So I think, it's a bit of an uneasy piece at the moment.
Yeah, I think we're reminded that the buy everything rally's still on, James, and people are still in the mood to believe and want to buy stuff. And while, it's very obvious that maybe getting out of hand, right now sentiment is people are cheering this thing on. Yeah,
and we should note the ASX 200 hit another record level this week, so party on in Australia. Okay, Anthony, or should I say, okay, boomers, it's time for our first topic. Well, this week we had some great new research from UBS chief economist George Therinau, who's been tracking Australian wealth for some time, and the numbers are stunning. Household wealth grew a staggering 7.7% in the September quarter, or $1.3 trillion to a record $18.1 trillion. As property prices soared and booming financial markets created sort of double win for older households. Now, their super balances are surging and their retirement income is surging too. So household wealth per person, Anthony, jumped to a record high of $654,000 in the September quarter, which is pretty good going. We're the fifth richest country in the world, according to UBS Wealth Management. And get this, we've got the eighth most US dollar millionaires in the world, which is pretty extraordinary, given we're, 2% of the global equity market? It's a stunning number. But Anthony, there's another side to this coin. George also had some data on what financial assistance Australians are providing to their family members. A record 20% said they were helping a family member out, and most commonly they were helping them out with living expenses. I'm sorry for rambling a bit here, Anthony, but I wanted to set the scene. Is this country cooked, as the kids would say, when we've both never been richer, we're fabulously rich, but so many younger households seem to be struggling to get by and relying on assistance from their parents or grandparents?
Yeah, it's cooked, James. Maybe that's why Matt Common's sticking around for another 3 years, but I reckon he might need more than 3 years to solve this one.
Yeah.
Australia's always had its battlers, and that's okay. Life's not meant to be easy, and we think of ourselves as a land of battlers. But what we've always had is the ability to work one's way through that and to change your fortunes and to do it reasonably quickly, like in one generation. We got all those Second World War immigrants here in the 40s, and within a generation, they're some of Australia's wealthiest and most successful families. What's changed now, though, James, is just the sheer amount of wealth out there. I mean, most of it's paper wealth, but there's the value of people's assets. So, the boomers and their homes and investment properties, their superannuation. Just look at the share market. It's nearly 20 years into a long bull run.
Yeah.
And the longer that runs, the more it benefits the people with the assets. So asset prices across the board are up, equities, bonds, houses, gold, you name it. Like if you just take Australian Super's balance fund as a sort of indication, I mean, it's done 8% a year for the past 10 years, James. And if you think about the compounding effect of that, if you're running at 8% a year, it only takes 9 years for you to double your money, right? So that money's all just sitting there, just doubling in value, or the assets are sitting there doubling in value every 9 years. And it's all just really compounding. And the ones that benefit the most are those people with the assets. Those historical returns, they're no good for anyone starting out with zero today. It just makes everything more expensive. Houses, equities, gold, crypto, you name it. It makes it harder to actually get into it. And for me, James, this is one of the sort of unintended consequences of super, or maybe not unintended, but I'm sure it's something we haven't had to think about too much before. Like super's great. It's universal.
Yeah.
As the former Prime Minister Paul Keating would say, it's the first time ever that you've had, mechanics and abattoir workers and whatnot have professionally managed life savings. And that's a really good thing. But the people it's benefited the most are the ones that have actually got the most money in the system, because it is quite generous in its tax advantages it offers, and they're the wealthy people. So I thought it was really interesting research from George at UBS, James, and the way he frames it really spoke to me. He talks about the balance sheet, the financial assets, the value of those growing, and then like the income side, the real economy not keeping up. So you've got this mismatch between the value of assets out there and then how people are actually feeling and the money that people are making along the way. Now, how is this dynamic changing the economy?
Yeah, well, in a few different ways. And we should say, Anthony, it's not that the boomers have done anything wrong. I mean, all the boomers I know have worked bloody hard all their life, made plenty of sacrifices, done all the right things, worked hard, got education, kept their heads down and kept building a life for their family.
For sure.
What they've benefited from is this massive upswing in asset prices that, as you say, has been going for more than 20 years. They've been in the right place at the right time, and that's what we're seeing. But it is starting to change the economy. And you can see people talk about, in America particularly, this K-shaped economy where you've got older, wealthier households continuing to spend at a rapid clip. And at the other side of the K, you've got younger, poorer households really struggling to get by. I think that's what this shows. So George's point is follow the money. You want to be in sectors that can benefit from that big spending boom. I think what we're seeing is it affect the sort of idea of intergenerational wealth transfer. So the idea is that, you don't get your inheritance till your parents die. That's starting to change. We're seeing, because of the high cost of property particularly, we're seeing that intergenerational wealth transfer happen much earlier because families are having to gift their kids large amounts of money, according to the UBS research, between 50 and 200 grand to help them get into the property market and get on the property ladder. So that's another change. I think the other change is politics, Anthony. We're seeing politicians realise the increasing rump of the electorate is now in the bottom of the K. They're in the younger, poorer end of the spectrum, and the shrinking part of the electorate's in the upper part of the K, the older, wealthier part of the electorate. So I think that's going to reshape politics. It has to. Politicians are going to have to listen to these young people. And I think this inequality problem was a big part of Treasurer Jim Chalmers' economic reform roundtable. I don't know if you remember that, Anthony. It was only a couple of months ago. But the momentum around it is just dissipated in an incredible way. But one thing that we sort of had a reminder of it this week was when Chalmers made some changes to super tax concessions. This has been really controversial, but the changes he announced this week do go to this inequality issue, don't they?
Yeah, I think they do, James. I mean, and it makes sense. If you've had this huge expansion on the financial asset side of the economy, and for most Australian, that's super and housing, and the real economy's not keeping up, where are you going to turn when you need to make changes to the tax system? So if you've got a Labor government with Labor values that likes spending, we've got all those things, you're going to go after superannuation. It's a bit of a no-brainer, isn't it? And in fact, you have to say, where else can you turn? We're paying so much income tax already. 30 cents in the dollar above 45 grand, 37 cents in the dollar above 135 grand, 45 cents in the dollar above 190K. Our big companies are already paying 30% tax, and that's not even including the payroll tax and everything they pay along the way. We're paying for consumption already with GST, 10% on all our purchases. So if you're the government, what are you going to do? It's hard to go after the property side of things because, you're talking about people's homes, politically very difficult.
Yep.
Super, also politically difficult, but the money's just sitting there. It attracts generous tax concessions. Remember, you're paying 15 cents in the dollar for money that goes into super. You're paying 15 cents on earnings in super. It's much better than you get on the outside of that. And the changes this week, James, so if you've got a balance over $10 million, you're going to be paying about 40% tax on the earnings in your super, as opposed to 15% prior. They were talking about 30% for $3 million plus. Now they're talking about 40% for $10 million plus. So I think basically they're going after the bigger balances even harder and then giving more leeway in that $3 to $10 million range. The other big change was not taxing unrealised gains.
Yep.
Now, they're the gains on things you've made on paper where you haven't actually sold them yet. You haven't actually realised any of the gains. So they're doing away with any talk of the unrealised gains. But we've spoken about a lot in the past 6 months, James. The government, they took these to the election. They won the election with a huge majority, but they've made these changes anyway. It's a bit of a funny world like that, but it feels like there's probably going to be more to come on these wealth taxes, don't you think?
I think so. I talked to the outgoing chairman of Australian Retirement Trust, second biggest super fund in the country, $350 billion under management. He's a guy called Andrew Fraser, former Queensland Treasurer and actually a good mate of Jim Chalmers. Mm-hmm. And he was blunt. He said this intergenerational cleave, he called it, is the big problem facing Australian society, and we're going to need to do more about it. Now, he says that involves super, but it'll need to be across the board in the way we think about how we tax people. And I think you're right. I don't think this is just a Labor government issue. I think if you're the Liberal government and your promise is, we're not going to touch anyone's wealth taxes, what's your pitch to young voters going to be? Well, keep working harder and you can pay for all the retirees. The costs of healthcare and aged care aren't going down, and that burden will disproportionately fall on younger workers. So I think this will be an issue that both sides of politics have to confront. It's not an easy issue. It's really politically difficult. No one likes to give up tax breaks or subsidies or free money from the government, but we're just going to be forced to do something about this because that intergenerational cleave, as Andrew Fraser called it, threatens the sort of fabric of what makes Australia great. To your point, that you can go from nothing to comfortable in a generation. That's just not possible at the moment, and that's I think Andrew Fraser called it the Australian project. That's a cornerstone of the Australian project that's just not working at the moment. So no easy solutions, Anthony, but we're going to have to do something.
More to come, as we'd put at the bottom of our story.
That's right. That's right.
Okay, James, let's get to our second topic for this week. And Australia got its latest dose of the AI boom when a homegrown company called Firmus announced plans to team up with a veteran of the data centre sector called CDC to build $73 billion worth of what it calls AI factories. James, I'm tipping a few of our listeners have heard of Firmus, but you got to talk to them this week. What do they do? What's their pitch about?
Well, yeah, it's a really interesting pitch. in the way it speaks to the AI boom. So there's lots of companies doing lots of different things in the AI boom. There's people building the sheds that we call data centers. There's people building the chips like NVIDIA. But what Firmus does is a very specific part of it. They do the cooling that's required to help these chips run efficiently. They've got this thing called the hypercube, Anthony. How cool does that sound?
Sounds good.
That they say can reduce cooling costs by over 90% and make these chips run a lot more efficiently and a lot more cheaply. Because what's important here is getting the price of an AI token down. So an AI token, when you ask ChatGPT, what colour socks should I wear today? OpenAI spends an AI token. That's if you're not a ChatGPT subscriber paid up. The cheaper that token is, the more profitable it is for everyone on that supply chain. So the idea of having a better, more efficient cooling system helps to reduce the cost of that token, helps to make AI more profitable for everyone, helps to generate a bigger return on this amazing amount of capital that the world is pouring into AI. The Firmus pitch here is that they want to be involved in the building of, as you said, $73 billion worth of data centres, or AI factories as they call them. They've got one going in Tasmania and another in Melbourne. And with CDC, they're going to team up and add to those two data centres with potentially data centres in Canberra and Perth and Sydney. So a big plan. I think it's instructive in a couple of ways. You can't do this stuff by yourself. That's why we're seeing lots of people team up together. So CDC wants to grow, Firmus wants to grow. Let's jump into bed together and get this happening.
Firmus's plans, James, 1.6 gigawatts of operational compute data centres by 2028. Our whole data centre market today probably is 1.5 gigawatts.
Right.
So they're talking about doubling what's already out there in the next 3 years. This stuff is exploding. The growth is insane. Now, James, Firmus raised $330 million in fresh capital last month in a deal that valued them at $1.9 billion and got NVIDIA as an investor. What's NVIDIA's role here?
Oh, well, I love these circular AI deals where NVIDIA's involved across everything. And this is a little classic of the genre down under. So we've got NVIDIA as a shareholder in Firmus itself. And then we've got NVIDIA as an investor in the individual data center projects. And then you'll never guess, Anthony, but as those data center projects come to life, whose chips do you think Firmus will buy?
There's only one.
Only one, NVIDIA. So it's one of these great circular things where NVIDIA seeds these businesses, seeds these data centers, and those data centers inevitably have to roll back and buy NVIDIA chips. So this is happening all over the world. I think everybody's a bit like, well, how circular is this? Is it real? But it's just the way of this industry. But we should say, Anthony, NVIDIA isn't the only investor here. There's plenty of local funds in this business now. Is there any chance that Firmus heads for the ASX in a float soon?
James, Firmus is zooming towards the ASX. It's the hot young thing in the IPO pipeline. Now that Chemist Warehouse is listed, Virgin's listed, GYG's listed, big names in the IPO pipeline are a bit thin on the ground. Firmus is sitting there motoring towards the ASX. It's a shame it isn't ready today because with the hype around the AI story, there's a very good chance of it getting away. One for next year, if markets stay like they are, I reckon, and you wrote this morning in the paper, James, that they won't be sitting on their hands with this. You have to feed the ducks while they're quacking. They are absolutely quacking for this. Australia's IPO market is really funny. All IPO markets are. They're so sentiment-based. But they run on hype as much as fundamentals. Word gets out about the hot ones and investors pile in via their funds on their personal accounts and that sort of thing. Firmus has already got that sort of crowd talking about it. The fund managers that bought in are talking to the brokers are pitching their own networks, they're pitching the company, they're trying to get on the ticket. Whether that means it goes well longer term, a completely different story. But in terms of getting a deal away, there's hype around it. So the short answer, yes, very much. This thing wants to head to the ASX. Could be the biggest data center float since the last big data center float, James, which was only this time last year.
Yes.
Remember David DePillo's Digico raised $2 billion. It was the biggest IPO, I think, 7 years, I think it was. The IPO was at $5, been trading below $3 this week.
Right. A cautionary tale, perhaps, Anthony. Which brings me to my next question. How do you reckon local investors are seeing this AI bubble from Australia at the moment? Now, I can sense the excitement that's building around Firmus. How many local investors do you reckon understand the hypercube cooling system? Or are they all just want to get on the hot thing here?
Yeah, barely any. I mean, I think if you asked them what hypercube cooling system was, they'd probably guess it was something you put in a Formula One engine. James, not at data centers, but we've spoken quite a bit on this podcast about asset prices, about this buy everything bubble, you know, stocks, bonds, gold, property, etc. That's all okay. You know, that's bull market stuff. And if you're an investor, you're better off to be invested in a bull market rather than just watch and miss out. But AI has been a big part of it. You know, the big tech stocks account for about half the S&P 500's gains this year. I mean, S&P 500, biggest market in the world, it's up 14% this year. There's a chance it could do 20% for the calendar year, which will be the third year in a row. Really, really amazing. And the reason that it's had so much momentum behind it is, you know, the hype and also the earnings coming from the big tech companies, this investment in AI, the tech, the data centers, you know, it's creating this sort of like snowball that's just rolling faster and faster and getting bigger and bigger. And James, I think investors have been okay about that. You know, I know there are lingering doubts in people's minds, but I think they've been okay about it. They can see earnings. They can see that there are multiples that can justify. I mean, you do have to believe in the story, but it's sort of within the realms of possibility. But what's changed, and this particularly in the past month or two, is the way that these AI players, and NVIDIA's at the absolute heart of it, but also, you know, OpenAI and now Australia's little Firmus, you know, the way that they're doing these stonkingly big deals with each other. You know, they're signing these supposed orders and promising this huge investment, you know, the sort of numbers that no other company in the world is throwing around. Yeah. You know, OpenAI has made US $1 trillion worth of deals this year. Like, it's just huge. Money that it couldn't even fathom of seeing or raising or being involved in, you know, 6 months ago or 12 months ago.
The OpenAI is going to lose $10 billion US this year. I mean, I don't know where they're getting the trillion from.
Yeah, 100%. So if you speak to people within this industry, in data centers in particular, I mean, Craig Scroggy at NextDC, for example, I mean, he'll tell you it's all moving so quickly in the US. You know, the growth's off the charts, seriously game-changing stuff going on for society, for business, for investors. And maybe he's right, but, you know, at some stage, all the money that's flooding into the sector will be like, show me the money. Yeah. Where are the returns on this, right? It can't just be an investment story. There has to be a return on investment. So it's at some stage that thought will go through people's minds. But I think just the way that these companies are all starting to deal with each other, James, I mean, that's what has the lights flashing at the moment.
That show me the money question, I think people will probably leave that for 2026 now. As you said, it's amazing what the prospect of another 20% year can do for people. They'll put their doubts aside. That's a next year thing to worry about. But next year we will start worrying about it, I think. And yeah, there's no shortage of bubble talk. If this bubble pops, it'll be the most predicted bubble popping in the history of the financial market. So we're all on bubble watch, that's for sure. All right, Anthony, we better chuck ourselves in the hypercube for a second and cool down. We'll be back after the break to talk about the biggest political meeting of the year. Back in a second.
A new true crime podcast you need to hear to believe.
I need police right now. I've just stabbed and broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony. Oh, we've waited so long for this one, but it's finally happening. October 20. Anthony Albanese is going to meet Donald Trump. How exciting.
What do you think will come out of this meeting?
I think Albo's going to need to take a present. Doesn't everyone take a present, like a gold present to Trumpy these days?
Like an R.M. Williams whip or something.
Ooh.
A new Cobra.
I like that. Yeah, that's not bad. Or maybe a I don't know, a gold model of an AUKUS submarine or something like that. Something. I mean, look, there's been a lot prattling on about this meeting. Will anything of note, anything of importance get resolved?
Oh, no, but it's symbolic, isn't it? I mean, but there is plenty to talk about. The critical mineral stuff obviously has been in the news all this week. We've been talking about AI and big tech. I mean, surely that gets a mention as well.
Yeah, that's true. And there's always the tariffs to talk about in Taiwan and China. So, yeah, I guess my reticence is that Anthony Albanese and Donald Trump could talk about something in the Oval Office, and even before poor old Albos left the White House gates, Trump could contradict something he said in the meeting. So anyway, let's see how it goes. On Tuesday and Wednesday, we've got the Energy Summit, the AFR Energy Summit in Sydney. Really interesting time for energy at the moment, Anthony. Those data centres tend to eat up a lot of energy. And of course, the renewables rollout is it's still stalling. We've got a lot of concern about gas policy in this country. Are we going to resolve it all on Tuesday and Wednesday, Anthony?
Somehow we're in the position, James, where we've got separate gas and electricity market reviews going on at the same time. Yeah, we've got these data centres coming in, demanding more electricity. We've got the smelters on their knees asking governments for handouts. I mean, they're the big electricity users at the moment. We've got the transmission problems. We've got pushback from communities on wind farms. There's a lot happening.
It's going to be great. We're doing a live podcast at the Energy Summit, and we're hoping to bring a slice of that to you next week to wrap up some of these big topics in energy. So watch out for that. And Anthony, it's AGM season, annual general meeting season, when the boards of our great companies and their management have to face investors and get yelled at and get voted against and then share a sandwich afterwards. AGMs this week: APA Group, Magellan, Sigma, ASX, BHP, IAG, Perpetual. CBA had its AGM this week. Any others that have caught your eye?
Mate, to be honest, it's been a bit sort of quieter than usual. I mean, Origins was this week as well. You know, last year and the year before that, we had heaps of strikes, investors voting against remuneration reports. We're not really seeing that activity come through yet. Yeah. But AGM season's, you know, it still only is in its early days. So I reckon we're going to see some big votes coming up next few weeks.
Yeah, ASX might have a interesting voting session. And James Hardy is the other one we've talked about on the podcast. That's going to be fun too. We love questions here on the Chanticleer podcast. This week our question is from Carol in Queensland. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can send us a question in audio form. And to do that, just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, there's a widget on all Chanticleer articles on afr.com that subscribers can send us a question to. So Carol asks, does anyone have any idea of the actual size of the private credit market? Do we have regulatory loopholes in private credit that's creating a time bomb waiting to implode? Carol, this is a wonderfully timely question, because this week, Anthony, we had JP Morgan Chief Executive Jamie Dimon warning that there's some cockroaches in the private credit kitchen that he's getting a bit worried about. He's seen one. There was a US car parts maker, First Brands, that's collapsed with a lot of private credit inside it. Yeah. And Jamie reckons where there's one, there's always another. And that's starting to be proved right, isn't it? We are seeing some strange noises out of the US private credit sector. US private credit share prices are being smashed. But is this systemic, or is this just something for bears to worry about because they can't worry about AI?
Good question, James. Great question, Carol. I love the question. Simple question. What's the size of the private credit sector in Australia? You'd think there's a simple answer, but there's absolutely not. And that sums up the private credit journey we've been on in the past year or so. You might remember a year ago, James, the Reserve Bank tried to define Australia's private credit sector. Yep. And they pegged it at about $40 billion. Yep. 40. A paltry $40 billion. I remember seeing that and thinking, hold on, doesn't Metrics, which is just one firm, have about $20 billion in assets? Yeah. Are they saying it's half the private credit sector? Doesn't Australian Super have another $10 or $20 billion in private credit? I mean, the latest numbers, ASIC had a go. They had a couple of experts who came in, and in their report out last month, they were talking about a $200 billion private credit sector in Australia. Yeah. About half of that would be in property. I mean, to be honest, feels like a little bit of a stab in the dark. There's not much explanation around that $200 billion number. It's been picked up relatively broadly since, but I think the point is it's probably bigger than you think. probably more of it out there. No one really knows for sure. This isn't an APRA-regulated sector like the banks who report on a month-by-month basis. So there is a big private credit sector now. It's particularly big in the property market, in the construction market, and there are risks developing in that sort of broader financial system from it. That's why we're seeing the regulators and everything take a look. And I mean, the US is way in front of us, James, right?
Yeah.
I mean, the problems they're going through, we're headed in that direction here.
Yeah, and even in America, the estimate of the size of the private credit sector is about 1.7 trillion US.
Is it?
I mean, what's Nvidia? 4.5 trillion. So,
Yeah.
so the danger or the fear that this is systemic is probably a bit overdone. But I think perhaps what Carol's getting to is we don't know what we don't know. It's private credit. You don't get to see everything. There's been a lot of money flowing into the sector. How well has it been lent out? Has it been lent out to risky borrowers where the private credit lender doesn't understand the risks? Now, we've seen a couple of blow-ups in America, and that's got everybody worried. The one thing I would say, Anthony, is the private credit sector in Australia is very different to the private credit sector in the US. In the US, private credit was born lending money to private equity companies, and it's expanded a bit since then, but it's mainly about lending money to companies. In Australia, private credit is mainly about lending money to property and property developers. And so I reckon that the Australian private credit sector has been able to give itself a cool name, private credit. I mean, how good's that sound? When really it's non-bank property lending. A lot of it. And so I think, if you're going into the Australian private credit sector, you want to go in with your eyes open. We had Australian advisor to big international funds, James Aitken, at the City conference this week. Mm-hmm. He had a great line. I'd only trust a private credit specialist who's been through at least one cycle, one downturn and one upswing. And I'd prefer to trust someone who's been through three of those. There's not many of those around, and you want to be very careful about picking the right manager in this area. I think that's what we're relying on, that the managers are doing the right thing. It's there's no guarantees there, Anthony.
Do they have the customer at the heart of everything they do, like ANZ's going to?
I'm not sure. Not sure. That is a question for our horizontal management team to get onto next week, I think. We'll get a couple of consultants in. All right, Anthony, a big week, and I'm looking forward to seeing you in Sydney next week to tackle all things energy. It's one of those summits where you can come away either extremely depressed about the state of our energy markets or a little bit hopeful. Let's hope we're leading to the second way at the end of a couple of big days.
Absolutely, James. I'll see you next week.
Fantastic. Thanks for listening. We'll look forward to speaking to you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson and Anthony Macdonald, and it was produced by Mandy Coulin and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.
A new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager, and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alva Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alva Beach, Death at the Door, wherever you get your podcasts.